Ladies and gentlemen, welcome to Destination Retirement with Robert Kuhn.
Time to get on board with Robert Kuhn from Kuhn Capital Partners. Retirement is a destination you've spent decades saving for. And what you do with those savings can make all the difference in the life you live once you get there. Income planning, wealth planning, tax planning. Destination Retirement with Robert Kuhn starts right now.
Welcome. You're listening to Destination Retirement. My name is Robert Kuhn, president and founder of Kuhn Capital Partners. Thank you for joining us this week. Hopefully everybody is having a great summer. Markets have been pretty volatile. A lot to go over this week. So as you know, we're going to provide as much education as we can in a 1-hour show every single week. That's our goal. That's our objective. And I am happy to report that given the response to the radio show, obviously we believe that we're doing something right. So we're going to continue to just educate. 630-492-1912, 630-492-1912. If you'd like to get on our calendar, if you'd like to learn more about our investment strategies, if you'd like to learn more about the investment industry, the good, the bad, the ugly, we certainly would love to have a conversation with you. You can also visit the website at kuhncp.com, kuhncp.com, and you can set some time up to have a initial meeting or a phone call or a Zoom or however you would like to get in touch with us to go over your current personal situation. We would love to do that. So banknotes, as you know, if you've listened to the show for any length of time, we are very big proponents of the banknote strategy. As always, it's important to know that anything I talk about on the radio, no matter what it is not investment advice, because we don't know your individual situation. It may be appropriate. It may not be appropriate for you. So truly it is for educational purposes only. And the point of sharing different strategies, the point of talking about the investment industry is really to get you to think, especially in this market. And when you look at the valuations in the market, I think you need to start thinking now. And if you haven't reviewed your portfolio, if you have not reviewed your financial plan for what could happen if we see a prolonged sideways market where there's little growth, you need to do it. And the best statistic to show that is Microsoft. If you had bought Microsoft in 2000, yes, it was at the high. There's no doubt about that. But if you had bought Microsoft in 2000, it took you 14 years to get back to even. And so just think about that stat and compare or kind of benchmark that stat to your portfolio. And if we are in a prolonged sideways market, how will your portfolio do? And if you are not convinced that it would meet your goals, your objectives, that your advisor would be adding significant value, then we need to have a conversation. So 630-492-1912. The banknote strategy, again, is doing well. We priced our traditional index-based strategy. As you know, we have Tier 1, Tier 2. The most recent we priced Tier 1 was at 12.2, I believe, a little lower than we anticipated, given kind of what, the volatility in the market the day we priced it. But, thank goodness we price it with volume. And when we do volume, you obviously are going to get higher rates. So that's good. I think that one had, 4 million maybe, plus or minus. I can't remember that note. But Tier 1 came in at 12.2. Tier 2 came in at just over, let's just call it 10. I don't know if it was just over 10 or at 10. Any way you look at it, still having a downside buffer of 30% before you don't get paid your monthly coupon, I think is still a very, very strong strategy, especially if we're in a sideways market. Our mini Mag 3, as we call it, Google, Amazon, and I believe it's Tesla, I think we priced. That came in at 22.4%, 22.4%. So that was a good one, obviously, but that's, more of an equity play. But a lot of people wanted that. A lot of people were looking for a more growth-oriented banknote. All great banks, as you know. So, we use, J.P. Morgan, Citi, Bank of America, Morgan Stanley, UBS, et cetera. So if you haven't gotten on our calendar to go over the banknotes, if you have not watched our educational video on how the banknotes work, we strongly suggest you do that. Every banknote does have a prospectus, so it's important that you read it. It's important that you have a conversation with us. It's important that we learn more about your situation. But where we think it fits is that if we are in a sideways market, and I don't know what market we're in, nobody does. And people on the radio, unfortunately, are generally more times than not, at least is my belief, selling, annuities. And so they're going to try to scare you. We'll talk a little bit about that here in a minute. Again, kind of the lifetime income stuff and my thoughts on that and inflation. But they're going to try to scare you into the market going down. Markets can't keep doing this. They can't keep doing that. The reality is nobody knows. Markets can go up significantly. They can go down significantly. They can stay sideways for an extended period of time. And I think the job of an advisor through planning is to make sure that even if the markets are in a unfavorable time period, that you still have some strategies in place that can deliver some sort of cash flow, some sort of return, et cetera. And that's the banknotes. And the banknotes, with that 30% downside buffer before you don't get paid your coupon is something that, we find very appealing. Kind of as a hedge, and those returns are nothing to sneeze at. I mean, they're good. I mean, you would think that historically, the equity returns are, if you look at long-term averages, if we're getting the banknotes with a significant buffer on the downside, it's and still beating, if all coupons are paid and the markets don't go down more than 30%, I think it's a very compelling story. And we kind of call it the blue ocean strategy in that there's not a whole lot of competition, which is surprising to me because the job of an advisor is to articulate strategies that you're readily not probably familiar with. They're not mass marketed. That's our job. That's what we do, and we're going to continue to do it. It's kind of like the energy strategy, and I'm so happy to report that the interest in the energy strategy and our daily webinars that we do for the energy fund, the attendance has gone up and to the right, and I love that. And portfolio construction, as we often talk a lot about on the radio, I think is going to be critical if the markets don't continue to just go vertical. And it's not my statistic, but we use this statistic often that when the markets are at the current PE, now I haven't seen this statistic in a couple of weeks, so take it with a grain of salt, but I believe the PE is still in the category where at these levels, the 10-year annualized number, if we look at forward 10 years, 100% of the time has returned between -2 and +2%. So, again, it's a single data point. It's a single statistic that 100% of the time that has happened. But that doesn't mean it's going to happen because what happened yesterday doesn't mean anything going forward. And that's my concern is anything I talk about on the radio, anything that advisors share. When you use statistics, if there still is a remote chance that certain things can happen. And so that's, something that we're trying to guard against. And through our planning process in looking at the financial plan and looking at Roth conversions, even though you have a, maybe a multiple 7-figure IRA and you've been told no, that you can't do it or it doesn't make sense. Well, that may be true if you don't have an investment strategy that can offset your conversion income, the additional income that you're going to get for the conversion. So 630-492-1912, 630-492-1912. But on the energy strategy, tax benefits, we received the draft of the tax benefits for last year, and they were significant. Again, we're not tax professionals. We can't provide tax advice. It's always best practice to make sure that anything I reference on the tax side, that you're doing your own due diligence, that you're talking with your own tax, advisor, et cetera. But we saw the draft for the fund, and we always articulate 80% target. So for every 100,000 You reduce your taxable income by $80,000. It looks like, again, first draft, that last year's is going to come in meaningfully higher. So we're pleased with that. So if you had invested in 2025, again, we err on the side of always being conservative, but it looks like, assuming there are no significant changes from draft to final, which there could be, but we generally don't anticipate it. But it is coming in meaningfully higher than the 80% target. So we're very, very pleased with that. So if you're a high wage earner, you're sold a business, sold a property, have concentrated stock positions, if you're looking for a strategy that is diversified from the equity markets, get on one of our daily webinars and just call 630-492-1912. 630-492-1912 and ask Maria for the link to sign up to the Bison 2 webinar, or you can say Energy Fund webinar. She'll know what you're looking for, and sit through it. If tax benefits and uncorrelated returns to the S&P 500 in the energy space are something that interests you, then do your due diligence. The offering is made by a private placement memorandum, so this is really for educational purposes only. You do need to be accredited. Accreditation is a couple ways now. Minimum net worth of $1 million, not including your primary residence, $200,000 of single income, $400,000 of joint income, with the anticipation that will continue. Or I believe, and you have to double check, but the SEC now has determined that if you put $200,000 in a private investment, that you are automatically accredited. But you need to be accredited. But come to the webinar. We do them daily, most days. Some days, if we have a meeting, we'll cancel it and push it to the next day. But again, these are the strategies that we're doing between that and the bank notes, and then the planning side of our firm that we believe totally puts us in a different category. So 630-492-1912. Really get on that webinar, 630-492-1912. We also have a video on the bank notes if you'd like to watch that. But I saw a great article this week. The mass affluent are losing their allure for wealth managers. What they considered the mass affluent to be was individuals that have liquid assets between $100,000 and $1 million. That's broadly defined as the mass affluent within the industry, are losing their allure for wealth managers. And I understand why. And, when we look at kind of the wealth management space, and you look at how wealth managers are compensated, if they're charging a fee, which almost everybody does, unless they're getting an upfront annuity commission, it really has become a very asset gathering game, right? If we manage $200 million and we are charging 1%, well, you can do the math and you can back into the math of what the advisor, the firm is making gross, and then kind of net out expenses. So what we have seen in the wealth management space is really just my belief, my opinion is that it has been less focused on true risk management and more passive investing, and advisors just growing their book because their fees go up. So we'll talk about that after the break. 630-492-1912, 630-492-1912.
Retirement looks different for everyone. Will you be sitting on your porch taking in the view, or will your porch be disappearing in the rearview mirror? Whatever your retirement dream, making it a reality starts with a plan. Robert Kuhn at Kuhn Capital Partners can help you create a financially secure and tax-efficient plan that is tailored to you. After all, you deserve to live your dream. Call 630-492-1912 and start planning for tomorrow and every day after. 630-492-1912 and visit us online at KuhnCP.com.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn, president and founder of Kuhn Capital Partners. We are a registered, SEC-registered investment advisory firm headquartered in Oak Brook. We do work with around 300 families in 24 states, manage a little over 200 million, growing rapidly. But that being said, we still don't want to get too big. My job as advisors or as kind of heading the direction of the firm is to always make sure that people feel not like a number. That we've seen a lot of consolidation, a lot of roll-ups, a lot of exit strategies that advisors are doing in the advisory space because the advisors want to monetize their life's work, and we get it. But then you just, I hear over and over again, people just, feel like they're just a number. And when you do strategies like we do, which again, the banknotes, so the banknotes are, something that we're, very, very entrenched in. I don't know how much we've done this year. Maybe 50 million-ish, maybe that's a little high of new issuance. But I know we've done over 100 million, significantly over 100 million over the last, 15 to 17 months. People want to learn. It's about hedging the downside. How do you hedge the downside? A lot of these, analogies that, it's like, would you ever drive a car? I heard one a long time ago. Would you ever drive a car that didn't have reverse? Nobody would, right? But, if you equate that kind of to an investment portfolio, generally when you're reversing, you're getting out of something, right, in the automobile. But when it comes to investing, very few investors have a true hedge in their portfolio, a true hedge, meaning that you have some sort of strategy, i.e. the banknotes that, certainly, if the markets or the indexes rather, or the individual stocks that the individual note is tracking are down more than 30%, well, that's an issue, right? You're not going to get paid that month. And so there are ways not to get paid, but you have a very significant buffer. Most recent ones that we priced, 12%, I think 12.1, 12.2. And then tier 2 was 10, and our mini mag 3, which is, we say mag 3 because the Magnificent 7, you can Google it and see the names, but Amazon, Google, Tesla is the note that we did. It did come in over 22% again, and I believe we did 40% downside on the coupon payment for that one. So, and I believe that bank was HSBC, but the big banks, Goldman, Morgan Stanley, UBS, et cetera. So. But 630-492-1912, 630-492-1912 if you want to learn more. If you want to get access to our webinar on our energy fund and, where we go over the tax benefits, where we go over the investment strategy, where we go over the non-correlation, it's new to people. Oil and gas investing is a niche anyways. What we're doing generally has been owned, private equity has owned that space. I'm not quite sure that there's a single fund that I am aware of that has is custodied or on the Charles Schwab custodial platform. We've went through that due diligence. Again, Charles Schwab doesn't say we're good or bad. They don't opine on whether the fund is going to work, et cetera, et cetera. It's not it shouldn't be viewed as an endorsement of our fund, but we are on the custodial platform. So those clients that do have accounts at Charles Schwab, you can see it on your statement. And we do have, it is all third party. So third party accounting, third party administration, third party, tax, third party everything. And third-party audit, and again, that's as an SEC registered investment advisory firm. We also have to have the fund audited to stay on the Charles Schwab platform. You have to have the fund audited as well, and so we've really created in the energy space. We're trying to democratize energy investing, and rather than having to write a multi-7-figure check just to gain entry into the non-operated space and the best, basin alongside the best operators in the world is our belief. We're doing it and opening it up to investors for $100,000 minimum. So again, we do daily webinars when we really encourage you that if you have any interest in learning about the tax deductions and learning about, the uncorrelated, cash flow / returns to the broader markets and why it may make some sense to have 5%, 10%, 15% of your portfolio in an investment that does not have a high correlation to the S&P, we strongly encourage you to attend one of the webinars. So they're about 40 minutes. You can listen to it. You can watch it. So ask Maria for the webinar of that, 630-492-1912, 630-492-1912. But the mass affluent, they say, not me, but they say from McKinsey & Co., they did the study. So I read the article on the 22nd. That the mass affluent, which is those that have liquid assets of 100,000 to $1 million, are losing their allure for wealth advisors. I can see it. I can see it because so much of the advice that's provided today is nothing more than passive investing, 60-40, 30, 70-30, just, answer these 10 questions, and then you're going to go into this, portfolio of equities and bonds. And to me, that is risky. That's my belief, especially at these market valuations. It is 100%, in my opinion, could be very, very risky. And if that's how you want to manage your money, I guess the advisors that talk about that and advisors that swear by that, I just wonder what value that they're bringing their clients. Because if you really want a balanced portfolio, if you want some version of 70-30, 80-20, 60-40, et cetera, you can do that. You can do that at Schwab. You can do that at Fidelity. You can do that at Vanguard. You can do that at places where you don't have to pay a fee. And if that's how you want your money managed, then I would strongly suggest that you do that because you don't need the fee drag. Now, I think that could be an issue, and I don't think that's the most appropriate way to manage money, but I also don't think that advisors that simply offer those types of strategies, which I don't have a statistical analysis of how many, but just based on gut feel, based on 30 years of knowledge in the industry, friends that I know, my peers and people that are in the business, I would say it's better than 80% of people that are simply offering those types of strategies, and then marketing it as unique, marketing it as proprietary. And it's worked because the markets haven't really gone down. But if you hold that statistic near you, that if you bought Microsoft in 2000, it took you 14 years to get back to even. 14 years to get back to even. And many of you listening are probably going to say, well, you're cherry picking the top. Okay, fine. Yes, 100%. If you had bought Microsoft a year later or 2 years later, it probably is a totally different statistical outcome. But who's to say that we're not at the top of the market now? So we're not calling for a bear market. We're not calling for major corrections. My fear is that statistic that where current PEs are, price to earnings ratios, historically speaking, that the markets have had a very low or negative 10-year number 10 years out, so 10-year return number. That's my concern. My concern is that if you're in a portfolio that doesn't have any true risk management, that doesn't have a strategy that can realize gains, that doesn't have a strategy that can, like the banknotes, for example, that have some sort of defined outcome. So the banknotes that we do track indexes, and we also have stock-based notes now that, well, they've always been there, but we've started to incorporate more of them now. But they have a defined outcome. The Tier 1 banknote we just priced, as long as the indexes that note tracks aren't down 30% on the monthly valuation, you're getting your coupon payment. So simply divide the 12.1 or 12.2 or whatever it was and get the, divide that by 12, and that's your payment for the month. So that's defined outcome. That is knowing that if this happens, I receive this. If that happens, I don't receive the coupon payment. And many, many people like that. Again, in these markets, I just think it's critical when you see and hear statistics that 40% of the market is being driven by 10 names or 40% of the market is being driven by 7 names. If those 7 or if those 10 names become out of favor, what happens in this world? What happens to the market, right? And we don't want you to get stuck in just having the sit and wait, and ultimately it's going to come back, because of course it's going to come back, but it could cost you significant time. So 630-492-1912, 630-492-1912, inflation and lifetime income annuities after the break. Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn, president and founder of Kuhn Capital Partners, SEC-registered investment advisory firm. We work in Oak Brook, but we do work with families in 24-plus states, or maybe it's 24 exact, 300-plus families. We manage a couple $100 million. That's growing. I think it's growing because of just our offering of portfolio construction, our offering of the banknotes, our offering of the energy strategy, our offering of the hedge fund strategy. We haven't really talked about that, and that's something that we really want to talk about. Our hedge fund strategy. Again, we kind of categorize, or we look at portfolio construction in a unique way. But if anything we talk about on the radio, again, it's for informational purposes only. I don't know you. You don't know me. I don't know your investment situation. I don't know your tax situation. I don't know your income situation. The job of what I do is to bring you ideas, and to bring you ideas to get you to think. And if you think that we could add value to your current situation that may not be value that may not be added today, let's talk. Let's get on our calendar, 630-492-1912, 630-492-1912. The energy strategy continues to grow in popularity here in the Midwest. Oil and gas investing is a niche anyways. The energy strategy that we have created is we believe it's a niche just because I've looked at so many funds. We've done due diligence on so many funds, and we wanted to really democratize energy investing and the non-operated space, which means really simply that if you're a non-operator, that means you're not doing the drilling. That means you're letting the Exxon, Chevrons, Conocos, Matadors, Vaqueros, Mewborns of the world, we would call them the biggest and the best, at least in our opinion, do the drilling. We are, as a non-operator, you're just a capital partner. You're a capital investor in their projects. And so if it's a 2% ownership in 10 wells, you get 2% of the revenue. You pay for your 2% of the drilling, you get 2% of the revenue. So we created a fund that commingles, that aggregates those ownerships. So it's all in the Permian. So Permian Basin, best oil field here in the United States without question. I believe the best oil field, and most believe one of the best oil fields in the world. So that's where our primary focus is, and it's not doing single well projects or 5 wells or 10 wells or whatever that most people who want oil and gas exposure have only had access to, unless you want to put in multiple 7 figures, generally speaking. That's what we've created. So we have significant current diversification in the fund. We're going to close this fund this year. We have about $20 million left of capacity. So currently we have 51 producing wells. We've got 13 different properties. We've got, I think, 8 different operators, all of which you probably would recognize as the industry's biggest and the best. And so we've created a fund that isn't reliant upon a single project. And it's a very private equity-backed space. And to gain entry, generally, most individuals for $100,000 minimum investment, they can't. And so that's why we are trying to create this asset class for individuals that want tax benefits. And again, tax benefits come with the investment, come with energy investing. I'm not a tax professional, I have to tell you that. I can't provide tax advice, but the tax benefits are significant. Last year, it looks like they came in meaningfully higher than the 80% target that we always talk about with new investors. So $80,000 per $100,000 invested, you can use to reduce your taxable income, active or passive. So if you're a CPA and you're listening to the show, you know this. And we have CPAs that have reached out for their own money to learn more about. Advisors, we're happy to say that advisors also are utilizing this for their current clients, and for advisors that are out there, given that we're in the same business, that we do have an RIA as well. We do have a form that a contract from our attorneys that is signed, a non-compete, non-disclosure, and whatever else, but basically says that we are unable to work with your clients, even if they wanted to work with us. So we wanted to make sure that advisors had that comfort that we can't work with them other than in the energy strategy capacity. And to me, as an advisor, that's a unique step up if you're out there raising money. And if you're out there, trying to bring strategies to your clients that are a differentiator, let's have a conversation. 630-492-1912, 630-492-1912. But inflation, as you know, inflation was kind of hot. We went, to the new Fed chair hoping that we're going to get rate cuts this year. We saw one of the large investment banks came out this week and said 3 rate hikes. That's just a single opinion. One bank, nobody knows what's going to happen. And I think everybody talks their book as far as what they hope happens so they can make the most amount of money. But if we start to see rate hikes, inflation is hot. And I think when you look at the annuity space and you look at the radio shows that are wrapped up as educational shows, financial planning shows, but they already know that whoever calls in is getting sold an annuity. That to me is an issue. And that's one of the reasons that we still do, the radio show, because of the amount of money that continues to go into those strategies where clients aren't fully aware of what it is. And that's my fear. And if you have somebody that really tells you the pros, the cons as they perceive them, and you still believe that it's a good investment for you, great. But the lifetime income, I think, comes with significant pitfalls or significant challenges. And one of them is inflation. All of these, the bulk of these lifetime income payments, yes, you can get raises. I don't know if I've ever seen an annuity give you a raise, or at least a meaningful raise. But are they going to keep up with inflation? Just look at Social Security. Most people's complaint about Social Security is the lack of inflation protection, the lack of keeping up with inflation. And when you buy a annuity, a lifetime income annuity, generally you're going to get a fixed payment of at least a fixed percentage, 5%, 6%, whatever, sometime in the future. And that is one of the best sleep at night features out there. I get it. But you have to look at what is inflation going to do to that payment. What is inflation going to do to that payment 5 years, 10 years, 15 years, 20 years out? And hopefully you know this, but you are only dollar cost averaging out of your personal investments, your own money, until that account goes to zero. When that account goes to zero, then you get into the insurance company's pockets. And so then they start paying you a check. So my belief is the insurance companies govern the growth, and they govern how much you can take out. So that doesn't happen. And so those are the things that I see far too many people selling these annuities based upon these illustrations that include back-tested numbers that even I would buy because they look so ridiculous and so good. But in the real world, the real performance is totally different. So if you own one and your advisor has went over all of that and you're still content with it, then great. You have the right to do that. It's your money. You can do whatever you want with it. But I see far too many advisors, unfortunately, not really dissect and educate on what it is and what it's not. And more times than not, it is being pushed as a longer dated strategy. And the bank notes, are going to pay you as long as the markets aren't down 30% right away, within the first month, and immediate cash flow. And you look at what that could do to that investment when you're starting to get immediate income. It's, it could be significant versus waiting, 5 years, 10 years, 15 years for, a future income payment that in the real world, as most people know, the growth on these, has been challenging. And even the ones that we've done on the lifetime income side have been challenging because of the interest rate market. And that was one of the things that we had to look at and reevaluate on, for those clients that are uber conservative, that are looking for, cash flow. Is there a better way? And I think you always have to be evolving. You always have to be stress testing. You always have to be testing your investment thesis. And it's okay to make changes, and it's okay to change. What you believe today may not be what we believe or you believe tomorrow. That's the job of an advisor. As new strategies, as new opportunities present themselves, you really have to look at them. So 630-492-1912, 630-492-1912. If you'd like to watch or listen or attend one of the webinars on the energy strategy, give us a call, 630-492-1912, 630-492-1912. We're going to, if it's not already there, on the website, kuhncp.com, kuhncp.com. If you go on the energy tab, we're going to, I don't know if it's there or not, I have to look at it, but if the webinar sign up, because we're doing them daily, is not there, then we'll make sure that it's added. But you can also sign up for one of the webinars there as well. So 630-492-1912. More after the break.
Retirement looks different for everyone. Will you be sitting on your porch taking in the view, or will your porch be disappearing in the rearview mirror? Whatever your retirement dream, making it a reality starts with a plan. Robert Kuhn at Kuhn Capital Partners can help you create a financially secure and tax-efficient plan that is tailored to you. After all, you deserve to live your dream. Call 630-492-1912 and start planning for tomorrow and every day after. 630-492-1912 and visit us online at kuhncp.com.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn, president and founder of Kuhn Capital Partners. Thank you for listening. We're headquartered in Oak Brook, SEC registered investment advisory firm, working with investors in 24 states, over 300 families. So we are really pleased with how that continues to progress. Let's talk about financial planning. I know we talked a lot about kind of investment ideas this week so far. But if you'd like to have a conversation with us, 630-492-1912, 630-492-1912. If you'd like to watch the one of our webinars, it is live, which is great. Most of the time it's live. We'll either cancel it or run a recorded one if we have a meeting that we can't get out of. That is at the time of the webinar, but we try to do them daily. Just simply because we're trying to educate, create a, really it's kind of creating a new asset class, because the non-operated working interest space is really predominantly owned by private equity and private equity backed, where in many instances, even investors that have 10, 15, 20 million, 30 million to give them, they just don't care. We do, and when you can look at and see what we're doing and educate, we can educate you on kind of what we're doing. We found the webinars to be very educational. So 630-492-1912, 630-492-1912 if you would like to attend, or you can go on the website, kuhncp.com, kuhncp.com, and sign up for one of the webinars there as well. So it's, summer, June is what June is, right? Hopefully everybody's enjoying their summer. Hopefully everybody's, forgetting about work for a period of time, enjoying the weather. I guess it hasn't been too bad. We're big golfers over here, so we try to golf as much as we can during the summer months and fall months and spring months and maybe even winter months. But that is a challenge. But the market's been cooperating. I worry that it is giving people a false sense of security. Again, investing, anything we talk about on the radio truly is for educational purposes only. It's because I don't know you. We can't provide investment advice without knowing you. So we have to make sure that we're giving you that that disclaimer. So anything we talk about, hopefully, if it piques your interest, you reach out to us and we can dive deeper into your individual situation, what your goals, your objectives, your risk tolerance, your timing, and then really take a look at how your portfolio is constructed today and see if that would meet or still succeed or deliver the returns that you expect if we're in a prolonged sideways market or flat market. That's my concern. That's the concern that I have, not necessarily a big market crash, even though many people will tell you that one is coming. I don't know if it's coming. Nobody knows if it's coming. But historically, the markets always go up over time. But time is different. What is time? Time is going to be different for every investor. And as you know, our favorite statistic is Microsoft. If you bought it in 2000, it took you 14 years to get back to even. So you bought it essentially at the market high or close to the market high. And who's to say that we're not in that period today? And so to me, when you look at financial planning, that's one thing that we don't talk enough about on the radio show. I believe every single one of our clients has a financial plan, a very thorough financial plan. And we use tax software that the industry also generally doesn't use. We absorb that cost for you. Can't provide tax advice, but we can give you as much look through of your investments on the tax side as we can, and then you can do with it as you wish. But most financial plans, what I have found, are just very basic, too basic, for, in my belief, just too basic. We see far too many people. We talked with a potential investor a few weeks back that, they had significant income and, they ran a plan, their advisors ran a plan and they had a 99% probability of, not outliving their income. And I have to catch myself because I can't say that that's not an important part of the plan, because it is. Knowing that you have, statistically speaking, enough income to last your lifetime is a very important feature of the plan, okay? But most people know that. I mean, most people intuitively know that they're going to adjust their spending or that their assets are going to ultimately last them. But that's where I have found most advisors stop. The way we look at financial planning is, let's look at the tax side of it. Let's look at the running out your RMDs to age 95. And if you have a seven-figure or multi-seven-figure IRA, what are your tax benefits? What are your tax liabilities going to look like when you have to start taking RMDs? Most people don't, I shouldn't say most people don't care, but something off into the future, whether it's 2 years, 5 years, 10 years, 15 years, unfortunately, people don't pay attention to. But we've seen, if you have a large IRA, your tax bill could be significant. The government could force you to take out $300,000, $400,000, $500,000, and look at that tax bill that you're going to have, and you're going to have to pay. So we look at that as planning. We look at that as opportunity to mitigate, to at least acknowledge, and to at least share ideas with you that you could start to implement now. And the Roth conversion story, most people know or have heard, the Roth conversion. And what we have found is the larger your IRA is, or the more money you make, the recommendations from advisors has been, it doesn't make financial sense. And on one hand, I could see that, because maybe it doesn't make financial sense because of the income that you're going to generate from the conversion. But what if you had strategies that could reduce that taxable income in the year of the conversion? What if you could use a strategy that provided significant tax benefits to offset ordinary or passive income? And then what does that conversion strategy look like now? Does it make sense to do that? And so we've found a real niche for, those investors that have seven-figure IRAs, multiple seven-figure IRAs, 3 million, 5 million, 7 million, 10 million, whatever, and pairing, the conversion strategy with energy or with the energy strategy or, strategies in general that have some sort of tax benefits to them. So when we look at financial planning, it's not just, do you have enough income? Because again, hopefully most people, you could do that plan online. I mean, there's plenty of plans out there. I mean, heck, in today's day and age, you can use AI, right? And put it in and it'll probably run it for you. So we want to take planning to the next level. And the beauty of it is it doesn't cost you, there's not a charge. There's not a charge for us to run a financial plan. It's an investment of our time to learn about you, to learn about your risk tolerance, to learn about your goals, to learn about your objectives, to look at your cash flow analysis, to really determine if you have a strategy that is ultimately going to meet your goals and objectives. Because if you knew already that you didn't, you probably would be seeking outside help. I mean, that's generally, I would think, is a pretty understandable statement. The problem is most people think they have something, but that they at least a lot of times that we have found, they don't have the risk management in place that you think, other than time, other than the markets going down significantly potentially, and then you sitting and waiting, and then ultimately the markets come back. That's a challenge. And so I really strongly encourage you to stress test your thinking on your current portfolio. If the markets were to go down, do you have something that can make money? Well, the banknotes, right? As long as the indexes aren't down 30%, you still are going to get monthly cash flow. Phenomenal, right? I mean, to me, that would be phenomenal. And so I'm articulating now our strategies. The energy strategy, the cash flow, that is the distributions that are provided, if any are provided to investors, they're independent of the S&P 500. So I still think the S&P drives everything, but they're independent of the S&P 500. And so you really need to start stress testing your thinking, stress testing mentally your portfolio, that if the markets are flat to sideways or down or below trend growth for an extended period of time, what does that do to your overall plan? And I just don't think advisors are talking about that. I don't think advisors are providing investors with strategies that can still be considered a success in that type of a market. And that's really at the heart of, I think, what we bring to the table that I think many advisory firms simply don't do. Hopefully everybody has a great week. I know next week is a short week for many people with the 4th of July, but 630-492-1912, 630-492-1912. That's one way to get a hold of us, to get on our calendar, to have an initial, consultation, whether you come in or whether we have a Zoom or whether we just have a conference call. We really want to help you test your thesis. We really want to help you test your advisor's thesis. We really want to help you stress test your current portfolio before something happens in the market. I don't know if it will. You don't know if it will. Nobody knows if it will. Heck, maybe the markets will just keep going up 20% a year forever, and everything that I talk about is irrelevant. And if that were the case, phenomenal. You don't need an advisor. But if that's not the case, a lot of the strategies that we talk about on the radio that may be new to you, well, you know what? Maybe, just maybe, they will add a benefit to you and your portfolio. So if you'd like to talk to us this week, next week, the following week, just certainly reach out, schedule your time, 630-492-1912, 630-492-1912, or do it through the website, KUHNCP.com, KUHNCP.com. I hope everybody has a great week. More next week.
This recording is for informational purposes only and should not be considered investment advice. Kuhn Capital Partners does not provide legal, accounting, or tax advice. Any statement regarding such matters is explanatory and may not be relied upon as definitive advice. Opinions expressed are current as of the date of this recording, and such opinions are subject to change. The views and opinions of guests on this program are not necessarily those of Kuhn Capital Partners. Any reference to guarantees, principal or income, protection, buffers, or defined outcome investments are generally structured notes or fixed insurance products backed by the claims-paying ability of the offering company and are not insured by any government agency. Coon Capital Partners is not affiliated with any guest unless otherwise stated and does not guarantee the accuracy or the completeness of any data presented. Coon Capital Partners and its affiliates are not responsible for any trading decisions, damages, or other losses resulting from or related to the information, data analysis, or opinions in this recording. Past performance is not a guarantee of future results. All investments are subject to investment risk, including but not limited to the potential loss of principal. Advisory services are offered through Coon Capital Partners, LLC, a registered investment advisor.